Question 1. Which of the following statements best describes the role of reinsurance in managing an insurer's solvency margin? A. Reinsurance acts as a mechanism to increase an insurer's premium income, directly improving its solvency margin. B. Reinsurance provides insurers with an effective method of risk transfer, allowing them to mitigate potential losses and maintain an adequate solvency margin. C. Reinsurance has no direct impact on an insurer's solvency margin, but only affects its capital reserves. D. Reinsurance only affects the insurer's balance, but does not contribute to solvency margin calculations. Answer. B. Reinsurance provides insurers with an effective method of risk transfer, allowing them to mitigate potential losses and maintain an adequate solvency margin. Explanation. Reinsurance helps insurers transfer some of their risks to reinsurers, which can mitigate large claims that could otherwise negatively affect their solvency margin. This reduces the financial pressure on the primary insurer and helps them maintain sufficient capital reserves to liabilities. According to Delaware's regulations and solvency requirements, reinsurance is specifically considered a critical risk management tool that can help insurers meet state solvency requirements, which are directly tied to maintaining adequate capital and managing liabilities. Therefore, option B is correct. Why the other options are incorrect? Option is incorrect because reinsurance is primarily a risk management tool, not a directly increase premium income. Option C is incorrect because reinsurance impacts solvency by reducing risk exposure and providing financial protection, not just through reserves. Option D is incorrect because reinsurance contributes to solvency by mitigating risk and providing coverage, not just in balance sheet reporting. Question 2. Which of the following clauses is most commonly found in reinsurance contracts to address disagreements between the ceding insurer and the reinsurer? A. Force majeure clause. B. Termination clause. C. Arbitration clause. D. Solvency clause. Answer. C. Arbitration clause. Explanation. In reinsurance agreements, the arbitration clause is commonly included to address disputes between the ceding insurer and the reinsurer. This clause requires that any disagreements regarding the contract be resolved through arbitration rather than litigation. Arbitration provides a more streamlined and confidential method for resolving disputes, which is particularly valuable in complex reinsurance relationships. Delaware law, as part of its regulatory framework for reinsurance contracts, supports the inclusion of such clauses to facilitate the efficient resolution of disputes without involving the courts. Why the other options are incorrect? Option is incorrect because the force majeure typically covers events beyond the control of either party, such as natural disasters, and does not address disputes between the parties. Option B is incorrect because the termination clause refers to the conditions under which the reinsurance agreement can be terminated, not dispute resolution. Option D is incorrect because the solvency clause deals with the solvency of the insurer or reinsurer, ensuring they have sufficient financial capacity, not with dispute resolution. Question 3. Mr. James is the risk manager at an insurance company in Delaware. The company is facing a significant surge in claims due to a series of natural disasters. James is considering whether to purchase excessive loss reinsurance. Given the circumstances, what should Mr. James primarily focus on when evaluating the terms of the reinsurance agreement? A. The potential for premium reductions through a quota-shared arrangement. B. The amount of loss coverage above the company's retention limit and the cost of reinsurance for catastrophic events. C. The ability to share risk equally with other insurers involved in the treaty reinsurance agreement. D. The historical performance of the reinsurer's solvency margin in prior years. Answer. B. The amount of loss coverage above the company's retention limit and the cost of reinsurance for catastrophic events. Explanation. In this scenario, Mr. James should focus on the amount of loss coverage provided by the excessive loss reinsurance agreement, which covers losses that exceed the insurer's retention limit, the amount the company is willing to bear itself. Since the company is facing surging claims due to natural disasters, the primary excessive loss reinsurance is to protect against catastrophic losses. The cost of reinsurance for such events will be a key factor in ensuring the company's solvency while managing significant claims. This is aligned with Delaware's regulatory framework for ensuring insurers are financially protected from catastrophic risks. Why the other options are incorrect? Option is incorrect because quota share arrangement, which is proportional reinsurance method, is suitable for managing the high risks of catastrophic events like natural disasters. Option C is incorrect because treaty reinsurance typically involves more automatic, predefined sharing of risks. which may not be the most effective for large losses in the case of catastrophic events. Option D is incorrect because while the solvency margin of the reinsurer is important, Mr. James should prioritize evaluating the specific coverage for catastrophic losses over historical performance. Question 4. Which of the following is a key risk management benefit of treaty reinsurance for an insurer? A. Allows the insurer to transfer all operational risks to the reinsurer. B. Provides a consistent and automatic sharing of risks across multiple policies without negotiation on a case-by-case basis. C. Guarantees the insurer a fixed amount of premium income from the reinsurer. D. Forces the insurer to cede its entire book of business to the reinsurer. Answer. B. Provides a consistent and automatic sharing of risks across multiple policies without negotiation on a case-by-case basis. Explanation. Treaty reinsurance allows insurers to automatically cede a portion of their business to a reinsurer under pre-agreed terms. This agreement applies to all policies within the scope of the treaty, which streamlines the reinsurance process and reduces the need for individual negotiations. This is beneficial for managing a wide range of risks and maintaining financial stability. Delaware's reinsurance regulations highlight treaty reinsurance as a key tool for insurers in managing large portfolios with minimal administrative burden. Why the other options are incorrect? Option is incorrect because treaty reinsurance does not transfer all operational risks. It primarily focuses on risk transfer related to specific policies. Events. Option C is incorrect because treaty reinsurance does not guarantee fixed premium income. It only outlines how risk is shared between the ceding insurer and the reinsurer. Option D is incorrect because the insurer is not forced to cede its entire book of business. The treaty reinsurance applies only to the specific terms of the agreement. Question 5. Which of the following factors would most likely cause an insurer to purchase facultative reinsurance? A. The insurer needs to share risks related to a portfolio of multiple policies in a standardized manner. B. The insurer is dealing with a large, high-value risk that exceeds its retention limit for a specific policy. C. The insurer seeks to spread risks evenly across a series of different geographical regions. D. The insurer wants a reinsurance agreement that automatically applies to all of its policies. Answer. B. The insurer is dealing with a large, high-value risk that exceeds its retention limit for a specific policy. Explanation. Facultative reinsurance is typically purchased by an insurer when it faces an unusually large or high-risk policy that exceeds its normal retention limit. Unlike treaty reinsurance, which covers a broad set of policies, facultative reinsurance is arranged on a case-by-case basis for individual risks. Form of reinsurance allows insurers to handle specific exposures, such as large commercial properties or high-risk assets, by transferring a portion of that specific risk to a reinsurer. Delaware regulations allow insurers to use facultative reinsurance for such targeted risk management. Why the other options are incorrect? Option is incorrect because facultative reinsurance is not used for portfolios of policies. It is designed for specific risks, not for portfolio-wide coverage. Option C is incorrect because facultative reinsurance is not typically used for spreading risks across regions. It focuses on individual risks. Option D is incorrect because facultative reinsurance is based on individual risk assessment, not a blanket approach across all policies. Question 6. Under Delaware law, which of the following is most likely to be required for reinsurers to conduct business in the state? A. Proof of a reinsurance treaty agreement with an insurer. B. A detailed record of all past claims handled by the reinsurer. C. A license issued by the Delaware Department of Insurance. D. Evidence of insurance coverage for the reinsurer's own business risks. Answer. C. A license issued by the Delaware Department of Insurance. Explanation. In Delaware, reinsurers must be licensed by the Delaware Department of Insurance to operate legally within the state. This licensing process ensures that the reinsurer meets all necessary financial and regulatory standards, such as solvency requirements, and complies with Delaware's reinsurance regulations. This is a fundamental part of maintaining a stable, secure reinsurance market in Delaware, and the department oversees and enforces these standards to protect both insurers and policyholders. Why the other options are incorrect? Option is incorrect because while reinsurance treaties are important, licensing by the Department of Insurance is the primary requirement for legal operation. Option B is incorrect because reinsurers are not required to provide a detailed record of all past claims for licensing purposes. The focus is on their financial stability and compliance. Option D is incorrect because reinsurers are not specifically required to have insurance coverage for their own business risks as part of the licensing process. Question 7. Mr. Clark, a claims adjuster for a Delaware-based insurer, is evaluating a large natural disaster claim that will likely exceed the company's retention limit. What should Mr. Clark prioritize when assessing the reinsurance recoverable for this claim? A. The amount of ceding commission paid to the reinsurer. B. The coverage limits and exclusions outlined in the reinsurance agreement. C. The historical performance of the reinsurer in previous years. D. The geographical location of the disaster and its impact on risk. Answer B. The coverage limits and exclusions outlined in the reinsurance agreement. Explanation: when assessing reinsurance recoverables for a claim, it is critical to examine the coverage limits and exclusions stipulated in the reinsurance agreement. This helps determine whether the claim qualifies for recovery and the extent of the payment from the reinsurer. Delaware's reinsurance regulations emphasize the importance of clearly defined contracts, especially when dealing with large claims or catastrophes. The reinsurance agreement will specify the terms under which losses are shared, including any deductibles, exclusions, and retention limits that may affect the recoverable amount. Why the other options are incorrect? Option is incorrect because the ceding commission pertains to the compensation the insurer pays the reinsurer, not the recoverable amounts for claims. Option C is incorrect because the historical performance of the reinsurer is relevant for evaluating financial stability but not for assessing a specific claim's recoverability. Option D is incorrect because the geographical location of the disaster, while important for risk assessment, is not directly related to the claim's recoverability under reinsurance terms. Question 8. Which of the following is true regarding the use of catastrophe bonds in reinsurance? A. Catastrophe bonds are a form of proportional reinsurance and share risk based on the insurer's premium income. B. Catastrophe bonds are used by insurers to transfer specific risks associated with natural disasters to the capital markets. C. Catastrophe bonds are primarily used for life insurance and health insurance risks. D. Catastrophe bonds are structured to provide fixed payouts to the insurer in the event of claim, regardless of actual loss incurred. Answer B. Catastrophe bonds are used by insurers to transfer specific risks associated with natural disasters to the capital markets. Explanation: catastrophe bonds are a form of alternative risk transfer used by insurers to offload the financial risks associated with catastrophic events, such as natural disasters, to the capital markets. By issuing these bonds, insurers can raise capital to cover potential losses from such events. These typically provide the insurer with funding only if a specified catastrophe occurs, and they are structured to be attractive to investors while mitigating the insurer's exposure to large losses. Delaware regulations support the use of catastrophe bonds as risk management tool in the reinsurance market. Why the other options are incorrect? Option is incorrect because catastrophe bonds are non-proportional reinsurance product, not proportional one. Option C is incorrect because catastrophe bonds are primarily used for property and casualty risks, not life or health insurance. Option D is incorrect because catastrophe bonds are linked to actual losses from specified event and do not provide fixed payouts regardless of the loss incurred. Question 9. Which of the following best defines the concept of runoff reinsurance? A. A reinsurance arrangement where the reinsurer assumes the insurer's future liabilities in exchange for lump sum premium. B. Reinsurance agreement used to wind down the liabilities of an insurer that is exiting the business. C. Reinsurance agreement that automatically applies to all new policies written by the insurer. D. Reinsurance arrangement that is used to cover catastrophic risks on an ongoing basis. Answer B. A reinsurance agreement used to wind down the liabilities of an insurer that is exiting the business. Explanation: runoff reinsurance is used when an insurer decides to exit certain lines of business or stop writing new policies. The reinsurer assumes responsibility for the remaining liabilities of the insurer's existing policies. This arrangement allows the insurer to manage its liabilities in an orderly manner while ceasing new operations in a particular business line. Delaware law supports runoff reinsurance arrangements as part of the broader strategy for managing insurer insolvency or exit from the market. Why the other options are incorrect? Option is incorrect because runoff reinsurance does not involve future liabilities being exchanged for lump sum premium. It is more about managing existing liabilities. Option C is incorrect because this describes treaty reinsurance arrangement, not run-off reinsurance agreement. Option D is incorrect because this describes catastrophic reinsurance arrangement, which is designed for ongoing risks, not specifically for the winding down of business. Question 10. In the context of reinsurance, what does the term retrocession refer to? A. The process of transferring risks from one insurer to another. B. A type of reinsurance agreement that focuses solely on life insurance risks. C. The act of a reinsurer passing on risks to another reinsurer. D. A form of reinsurance where the primary insurer retains the majority of the risk. Answer C. The act of a reinsurer passing on risks to another reinsurer. Explanation: retrocession occurs when a reinsurer, having assumed risk through reinsurance, further passes that risk on to another reinsurer. This helps reinsurers manage their own risk exposure and increase their capacity to assume more risk. In Delaware, retrocession is a common practice used in large-scale reinsurance arrangements. Question 11. Which of the following is an advantage of using quota-share reinsurance for an insurer? A. It allows the insurer to retain all of the premiums while only transferring part of the risks. B. The insurer cedes a fixed percentage of both premiums and losses to the reinsurer. C. The insurer does not need to share any premiums with the reinsurer. D. The insurer transfers the entire risk portfolio to the reinsurer. Answer B. The insurer cedes a fixed percentage of both premiums and losses to the reinsurer. Explanation: in quota-share reinsurance, the insurer agrees to cede a fixed percentage of both premiums and losses to the reinsurer. This helps spread the financial risk across both parties while ensuring that the insurer retains a portion of the premiums and risk exposure. Delaware reinsurance regulations allow for quota-share agreements that are flexible in terms of the percentage ceded. Question 12. Which of the following is a key difference between facultative reinsurance and treaty reinsurance? A. Facultative reinsurance is applied to individual policies, while treaty reinsurance covers a portfolio of policies. B. Facultative reinsurance is mandatory, while treaty reinsurance is optional. C. Facultative reinsurance involves a lump sum payment, while treaty reinsurance is based on premiums. D. Facultative reinsurance is exclusive to health insurance, while treaty reinsurance applies to property insurance. Answer A. Facultative reinsurance is applied to individual policies, while treaty reinsurance covers a portfolio of policies. Explanation: facultative reinsurance applies to individual policies where the insurer seeks to cede specific risks. Treaty reinsurance, on the other hand, is a broader agreement that covers an entire portfolio of policies, usually with automatic acceptance of risks. Delaware law supports both for reinsurance, ensuring clarity and flexibility for insurers. Question 13. What is the primary purpose of excessive loss reinsurance? A. To share a fixed percentage of all premiums between the insurer and the reinsurer. B. To provide coverage for losses that exceed a specified threshold, typically for catastrophic events. C. To cover the insurer's operational expenses rather than underwriting losses. D. To automatically transfer claims above a certain amount to the reinsurer without negotiation. Answer B. To provide coverage for losses that exceed a specified threshold, typically for catastrophic events. Explanation: excessive loss reinsurance is designed to protect the insurer from large catastrophic losses that exceed a predetermined threshold. It is particularly useful in scenarios where the insurer might face a sudden and large-scale loss, such as a natural disaster. Delaware insurance regulations govern how this form of reinsurance operates to ensure that insurers are protected from large, unpredictable events. Question 14. Which of the following is a potential disadvantage of using reinsurance for an insurer? A. Increased underwriting capacity to write more policies. B. Loss of some control over claims and risk management. C. Reduced need for capital reserves. D. Guaranteed profits from reinsurance recoveries. Answer B. Loss of some control over claims and risk management. Explanation: while reinsurance provides financial protection, it can result in a loss of control over how claims are handled and how risks are managed, as reinsurers may impose specific guidelines. This trade-off is something insurers must consider when entering into reinsurance agreements, especially in Delaware, where regulators ensure transparency in reinsurance contracts. Question 15. How does reinsurance support an insurer's solvency? A. by providing the insurer with capital to pay for claims without affecting its balance sheet. B. By spreading risk across multiple companies, thus reducing the likelihood of insolvency due to large losses. C. By guaranteeing that the insurer will never face financial shortfall. D. By ensuring that the insurer will always have enough liquidity to meet policyholder demands. Answer B. By spreading risk across multiple companies, thus reducing the likelihood of insolvency due to large losses. Explanation: Reinsurance helps insurers maintain solvency by spreading the financial risk across other companies. By transferring a portion of its liabilities to reinsurers, an insurer can avoid large losses that could threaten its financial stability. Delaware's solvency requirements emphasize the importance of reinsurance in maintaining an insurer's ability to meet its obligations. Question 16. Which of the following best describes the ceding insurer? A. The reinsurer who assumes part of the insurer's risk. B. The insurer who transfers a portion of its risk to a reinsurer. C. The company that manages the claims and payments for a reinsurer. D. The reinsurance broker who arranges agreements between insurers and reinsurers. Answer B. The insurer who transfers a portion of its risk to a reinsurer. Explanation: The ceding insurer is the primary insurer that transfers a portion of its risks to a reinsurer. This transfer of risk allows the ceding insurer to protect itself against large claims or unforeseen events. Delaware insurance laws require that the ceding insurer remains responsible for the obligations under the original policy. Question 17. Which type of reinsurance agreement would most likely be used for a specific high-value insurance policy that exceeds the insurer's retention limits? A. Treaty reinsurance. B. Facultative reinsurance. C. Quota share reinsurance. D. Excessive loss reinsurance. Answer B. Facultative reinsurance. Explanation: Facultative reinsurance is used when an insurer needs to cede a specific high-risk policy that exceeds its retention limits. This type of reinsurance is negotiated on a case-by-case basis. Delaware law supports facultative reinsurance as a tool for managing large, complex risks. Question 18. Which of the following describes proportional reinsurance? A. The reinsurer shares a fixed percentage of both premiums and losses with the ceding insurer. B. The reinsurer covers the losses only above a predetermined limit. C. The ceding insurer retains all premiums, while the reinsurer assumes a fixed percentage of claims. D. The reinsurer agrees to assume all of the insurer's risk for specific policies. Answer A. The reinsurer shares a fixed percentage of both premiums and losses with the ceding insurer. Explanation: Proportional reinsurance involves the reinsurer taking a fixed percentage of both the premiums and the associated losses of the ceding insurer. This type of reinsurance allows insurers to share risks and rewards proportionally, and Delaware's reinsurance regulations allow for these flexible agreements. Question 19. What is the primary benefit of stop-loss reinsurance for an insurer? A. It limits the insurer's liability to a specific percentage of total losses. B. It covers an insurer's losses once they exceed a predefined level of loss experience. C. It guarantees fixed payouts for all claims regardless of the insurer's actual loss. D. It automatically applies to all policies issued by the insurer regardless of risk level. Answer B. It covers an insurer's losses once they exceed a predefined level of loss experience. Explanation: Stop-loss reinsurance helps insurers by covering losses once they exceed a certain threshold, typically in situations where the insurer's losses are unexpectedly high. This allows insurers to better manage their risk while avoiding financial instability. Delaware regulations support the use of stop-loss reinsurance as part of an insurer's management strategies. Question 20. Which of the following is most likely to require the approval of the Delaware Department of Insurance? A. The insurer's decision to change its reinsurance partner. B. The reinsurer's decision to terminate an existing reinsurance agreement. C. The ceding insurer's decision to reduce the level of coverage provided by the reinsurance. D. The creation of new reinsurance company in Delaware. Answer D. The creation of a new reinsurance company in Delaware. Explanation: The Delaware Department of Insurance requires approval for the creation of new reinsurance companies in the state to ensure that these entities meet financial and regulatory standards. This oversight helps maintain the stability and integrity of Delaware's reinsurance market. Question 21. Under Delaware law, which of the following is a required disclosure for reinsurance agreements? A. The reinsurer's financial statements for the past 5 years. B. List of all policies ceded to the reinsurer. C. The amount of risk retained by the ceding insurer. D. The commissions paid to the reinsurance brokers involved. Answer: C. The amount of risk retained by the ceding insurer. Explanation: Delaware law requires that the ceding insurer disclose the amount of risk it retains in a reinsurance agreement. This ensures that regulators can assess the financial risk exposure of the insurer and confirm that adequate risk management practices are in place. Question 22. Which of the following is a key purpose of using reinsurance treaties? A. To avoid paying premiums for excess coverage. B. To reduce the administrative costs associated with facultative reinsurance. C. To secure fixed long-term payouts for the ceding insurer. D. To automatically share a fixed portion of premiums and claims across all policies covered by the treaty. Answer: D. To automatically share a fixed portion of premiums and claims across all policies covered by the treaty. Explanation: Reinsurance treaties are designed to automatically cede a fixed portion of premiums and claims, providing insurers with consistent coverage and shared risk management across a portfolio of policies. Delaware's reinsurance rules support the use of treaties to promote financial stability. Question 23. Which of the following best defines surplus relief in the context of reinsurance? A. A method for reinsurers to increase their own capital reserves. B. A way for insurers to increase their surplus by ceding excess risk to a reinsurer. C. A regulatory mechanism to ensure reinsurers have enough reserves to cover claims. D. A requirement that insurers hold a certain percentage of surplus to satisfy financial solvency rules. Answer: B. A way for insurers to increase their surplus by ceding excess risk to a reinsurer. Explanation: Surplus relief is a mechanism that allows insurers to offload excess risk to reinsurers, thereby freeing up capital and increasing their surplus. This helps insurers maintain financial stability and solvency, especially when they face unexpected high claims. Delaware encourages the use of surplus relief in reinsurance to stabilize the market. Question 24. What is the main regulatory concern when an insurer engages in reinsurance with a foreign reinsurer? A. Ensuring the foreign reinsurer has adequate capital to meet its obligations. B. Ensuring that the reinsurer's commission structure aligns with Delaware's regulations. C. Ensuring the foreign reinsurer pays all premiums in timely manner. D. Ensuring that the foreign reinsurer holds adequate insurance for its own risks. Answer: A. Ensuring the foreign reinsurer has adequate capital to meet its obligations. Explanation: The primary concern when an insurer engages in reinsurance with a foreign reinsurer is ensuring that the reinsurer has sufficient capital to meet its financial obligations. Delaware regulators assess foreign reinsurers' solvency to make sure that claims will be paid in case of a large loss event. Question 25. Which of the following is the primary objective of reinsurance for an insurer? A. To maximize profit through underwriting commissions. B. To reduce the cost of premiums charged to policyholders. C. To spread risks and protect against large losses. D. To guarantee the solvency of the reinsurer. Answer: C. To spread risks and protect against large losses. Explanation: Reinsurance helps insurers spread their risks and protect themselves from large catastrophic losses. By transferring part of their risk to reinsurers, insurers can ensure they remain financially solvent even when facing major claims. Delaware law promotes the use of reinsurance as a key tool for risk management. Question 26. Which of the following would be most likely to trigger a reinsurance claim under an excessive loss reinsurance agreement? A. A claim that falls within the insurer's retention limit. B. Claim that exceeds predefined loss threshold. C. Claim involving policyholders located in foreign countries. D. Claim involving long-term disability policy. Answer: B. A claim that exceeds a predefined loss threshold. Explanation: Excessive loss reinsurance is designed to cover losses that exceed a specific threshold. This type of reinsurance protects insurers from large catastrophic losses by transferring the excess risk to a reinsurer once the threshold is surpassed. Delaware's regulations govern the conditions under which such claims can be made. Question 27. Under Delaware insurance law, what must a ceding insurer disclose in a reinsurance agreement to ensure compliance with solvency requirements? A. The overall profit margins of the reinsurance agreement. B. The names of all policyholders affected by the reinsurance. C. The amount of risk the insurer retains and the reinsurance limits. D. The percentage of the insurer's premiums paid to reinsurers. Answer: C. The amount of risk the insurer retains and the reinsurance limits. Explanation: Delaware insurance law requires that ceding insurers disclose the amount of risk they retain and the limits of reinsurance to ensure that the insurer remains solvent and can meet its obligations. This information helps regulators assess the financial stability of the insurer and the effectiveness of its reinsurance strategy. Question 20. What is a loss ratio in the context of reinsurance? A. The proportion of premiums that an insurer pays to a reinsurer. B. The percentage of claims paid relative to premiums earned. C. The total amount of risk retained by the ceding insurer. D. The fixed percentage of premiums that the reinsurer is entitled to keep. Answer: B. The percentage of claims paid relative to premiums earned. Explanation: The loss ratio in reinsurance refers to the percentage of claims paid out relative to the premiums earned by the insurer or reinsurer. A high loss ratio may indicate that an insurer or reinsurer is paying out more in claims than it is earning in premiums, which could raise concerns about solvency and profitability. Delaware's regulatory framework monitors ratios to maintain market stability. Question 29. In the context of Delaware reinsurance regulations, what is the role of a reinsurance intermediary? A. To directly assume a portion of the insurance company's risk. B. To facilitate negotiations between insurers and reinsurers. C. To provide legal counsel on reinsurance agreements. D. To manage the claims process for the reinsurer. Answer: B. To facilitate negotiations between insurers and reinsurers. Explanation: A reinsurance intermediary plays a critical role in facilitating the negotiation process between insurers and reinsurers. They act as brokers, helping to match the appropriate reinsurance product with the needs of insurers while ensuring compliance with Delaware's regulations. These intermediaries help streamline the reinsurance process, making it more for both parties. Question 30. Which of the following is true about the regulatory requirements for reinsurance companies in Delaware? A. Reinsurance companies must have a surplus that is equal to or greater than 100% of the premiums they receive. B. Reinsurance companies must be domiciled in Delaware to operate within the state. C. Reinsurers must maintain sufficient reserves to cover both incurred and anticipated claims. D. Reinsurance companies are not subject to the same solvency requirements as primary insurers. Answer: C. Reinsurers must maintain sufficient reserves to cover both incurred and anticipated claims. Explanation: Delaware law requires reinsurers to maintain sufficient reserves to cover both incurred and anticipated claims. This ensures that reinsurers are financially capable of meeting their obligations even in the event of significant loss events. Delaware's regulatory framework aligns with industry best practices to maintain market stability, protect policyholders,